Okay. So these are going to be the last two cycles, cash is included in both the revenue cycle and the expenditure cycle, but the expenditure cycle will be the last business process we talk about in terms of the audit approach. And certainly when we talk about the expenditure cycle, we'll cover the concepts that we talked about in the revenue cycle, except that we will be viewing it from the perspective of the expenditure cycle. But I want to start out with talking about auditing cash. And so obviously cash is going to be a significant account in both the revenue cycle and in the expenditure cycle. Right? So when we talk about cash, the audit of cash, we're going to look at where the sources of cash. So how is cash generated? And obviously cash can be generated from the revenue cycle, right? Because you're selling goods to customers and hopefully you're collecting on those goods. But also, we're not going to cover this cycle, but cash is generated from the financing cycle, right? How is it generated through the financing cycle? Yes, John. Right, you sell stock. What else? Bonds. Company can sell bonds. Right? So there are a number of ways that you can generate cash, but we're going to focus on it from the perspective of the revenue cycle. Also, you can sell it through, generate cash if you sell property, plant, and equipment, and as you pointed out, issuing stock or long-term debt. And then we'll talk about today also the disbursement of cash. So how's cash utilized? And so we're again going to focus mostly on the purchasing cycle, right? Or the purchasing process, where you're either purchasing inventory or you're purchasing property, plant, and equipment. But also cash is dispersed through the payroll, right? You have to pay your employees, and we're not going to cover the payroll cycle. And again, through long-term debt and stockholders' equity, right? Long-term debt in the sense of paying interest on debt, on money that you borrow, and the equity section through dividends, a return to investors on their investment. So what you'll see basically is cash is prominent in all of the business cycles. We're going to focus, as I said, on cash receipts and cash disbursements particularly. So when we talk about cash, what we're thinking about is cash in the bank, right? So a company collects cash, they deposit the money, so we want to see that there are controls over cash. It's very important to have controls over cash because it's a highly liquid asset. So some of the misstatements that you usually see with respect to cash, because one of the things we'll talk about when we talk about the audit procedures for cash is that what we expect to see that companies are performing a bank reconciliation. So basically they are reconciling the difference between what's recorded in the general ledger in the cash account and what's on the bank statement. So auditors are going, that's a control that auditors are going to look for when they assess the controls over cash. And some of these things that you're unable to find by just merely performing a bank rec, right? Because a bank rec just says, okay, here's what I have on the books, here's what the bank says I have, what are the differences? The types of differences that are going to come up are going to be things related to timing differences. So timing differences for when checks are clearing the bank and when the company actually issued the checks, or timing differences for when receipts are recorded in the bank statement versus when the company actually deposited the receipts. The types of things that are not going to be there is a failure to bill a customer. Right? If you fail to bill a customer, you're not going to identify that by looking at the difference between your bank account and your books. Why? Why do you think that is? Why is that not evident by looking at the bank rec? What does failing to bill a customer even mean from a transaction or an accounting perspective? What happens? What does it cause? You fail to bill a customer, what does that mean? Yes, Vivian. There you go. Simple. It's not on the books. If you fail to bill a customer, you didn't put it on the books. So if it's not on the books, it couldn't possibly be in the bank because you didn't bill them. You didn't bill them, so it's not on your books. You didn't bill them, so you didn't send them an invoice. They're not likely to pay you. You don't send them an invoice, well, I guess I got it for free, right? So you'll never find that in a bank reconciliation. The other thing is if someone is embezzling cash receipts from customers, you're not going to find that in a bank rec either. Why? What control is lacking? Where's the control breakdown there? If someone's embezzling, everyone understands what embezzlement means, right? Just had this on a test. Might be why people got it wrong. What happens? If you're embezzling, what control has broken down if someone's able to embezzle money, cash receipts? Well, that's right, you have a lack of internal control, so it creates the opportunity to embezzle. But what's happening? When someone embezzles money, what control is not in place? Jimmy. Right, so those are all factors, but what's the control? So there's probably a segregation of duties.
What has happened to the functional capabilities, like the authorization?
Right, so it's probably that there's not a proper segregation of duties. That if someone has the opportunity to steal cash, that means that person has custody of assets, right? Cash comes in, or checks come in, and there's no oversight. There's no one checking to see, that the cash that comes in the door is immediately deposited, that someone's reviewing cash receipts. So there's a breakdown in internal controls. If they're embezzling the cash receipts from customers, there's a breakdown in internal controls. That cash never hits the bank. So you're not going to see that in a bank reconciliation, right? Because it never got deposited into your cash account. Right? So, and if it never got deposited into your cash account, you've never recorded it. Because if it's stolen, right, it's not as though someone's going to say, okay, let me record this cash receipts and then I'm going to steal the money. If they're stealing the money, they're never caught recording the cash receipts in anyway. So you're never going to see that through your bank reconciliation. Where might you see that? When might it come out that there's an embezzlement problem? What might raise a red flag? Accounting. Think about the accounting transactions. Yes. Right, you're going to see your accounts receivable, right? Because that receivable is going to be there. You're going to see that come out in your aging. Something's going to be wrong with the agent, right? There's going to be a red flag because you're going to notice that that customer has not paid you, right? The company's going to notice they haven't received payment for that accounts receivable. It's going to, and what happens when you don't pay? The company's going to send the customer another notice and another notice and another notice. The customer might ignore it, but more than likely a customer is going to respond that, look, I already paid you for that and here is a copy of my check and here is the clearance, the fact that the check cleared. So then that might point to a red flag, but that's not necessarily timely, right? Because there's a breakdown in internal controls. So all of that to say, basically, there are errors in cash or misstatements that could occur in the cash that you will never find as a result of doing a bank reconciliation. And that's to say that just merely doing a bank reconciliation is not enough to identify misstatements in the cash account. You have to look at the controls over cash when you're looking at controls over cash receipts and cash disbursements. Other types of misstatements that are commonly that are common to the cash account would be duplicate payments. And again, this points to controls over the expenditure process or controls over the disbursement process. Again, you would want to see, and we'll talk about this when we talk about the expenditure cycle, is one common control an auditor expects to see when you walk in is that there's a match, what we call a three-way match. And a three-way match says for every cash disbursement that's made, or for cash disbursements, I expect to see that there is a corresponding purchase order, which is authorizing, the purchase order basically authorizes the disbursement, that there's a receiving report, that tells me that I received the goods, and so it's valid, right? I should be paying for it, and a vendor invoice, I've been billed for it. So to support that disbursement, those three documents should be included in a cash disbursement. They should match. And when those payments are made, the voucher package should be stamped, paid, some indication that it was paid to try to avoid duplicate payments or mitigate the chance of duplicate payments. So that, again, is a misstatement that you'll see. And the companies do have, we actually have some of our PhD students in AIS working on these types of projects where they're looking at how companies can control or mitigate duplicate payments. Because sometimes duplicate payments occur just because of the way information is entered into the accounting information system. So someone could enter in H.L. Brown, and somebody else might enter in H. Brown. It might show up in that company's vendor master file as two different vendors, when in fact it's the same vendor, which could cause sometimes duplicate payments. Improper payments of personal expenses. You see this when companies have, for example, they give their employees, say for instance their salespeople, credit cards, company credit cards. And or they give departments credit cards to purchase goods, right, just for that department. And you'll see that sometimes people will take advantage of that. So they'll go to, Target and they'll purchase their own goods, their own personal property on it, thinking, oh, I'll pay it back, right? But that's not the intention of a company card. Yes, Jimmy, did you have a question? P cards, yep. You have P cards and they're basically a credit card, right? And so those, and you'll also see, and especially for employees who travel a lot, right? A company tries to mitigate, they don't want employees, you're traveling on business, they don't want a person to have to be responsible for any company or business expenses. That's not the case at Rutgers. I have to charge everything on my credit card and get reimbursed. But a lot of corporations don't want that, right? So they give their companies, their employees credit cards, and you're supposed to use those credit cards for business only. You're not supposed to use it for your own personal expenses. Even if you pay it back, you're not supposed to do that, and a lot of companies have strict policies against it. But it's harder to control, and so you do have employees who will use company cards for personal expenses, and sometimes those expenses are, a company ends up paying personal expenses as opposed to just business expenses. I'm not sure what happened here. Another thing is payment for raw materials not received. So again, this is where the receiving, when I talked about the three-way match, again, this is really important where before a disbursement is made, there's evidence that the goods related to that disbursement was received, and that helps to mitigate this misstatement. So again, auditors are going to look for those kinds of controls, and payment to employees for hours not worked. And again, if you look at these types of misstatements, so much of it relates back to the company's controls, internal controls over the process. Other types of misstatements which would normally be captured or discovered as a result of doing a bank reconciliation is whether or not there was a failure to include a check on the outstanding checklist, right? Because if you did not include that check on the outstanding checklist, if you issued a check, eventually it's going to clear the bank, right? And so you will see that as a reconciling item between the books and the bank statement. And then cash received by the client recorded in the wrong period. So let's say, for instance, the money was received at the end of December, but the client recorded it on the books and records as January. You'll see through the bank statement when that deposit was actually made, right? Because the bank is generally going to show the deposit on the day that you deposit the money. So these are the types of misstatements that are identifiable by performing a test over the bank reconciliation process. So as I did with the revenue cycle, let's kind of take a look at what do we mean, what kinds of tests are we going to perform over cash? Because cash is a balance sheet account, right? So you expect to see cash showing up on the balance sheet, but because cash is so much a critical part of the business process, you're going to also expect to see tested controls over cash related to testing the controls for those business processes, such as the revenue and collection cycle and the expenditure cycle. So again, cash, very simple. We have cash coming in and we have cash going out. And we talked about the way cash is generated versus the way cash is dispersed, what gives rise to disbursements. And so what you're auditing these beginning balances, the receipts, how cash is generated by looking at the revenue cycle, right? So we're just going to focus on the revenue cycle. So you're going to look at cash receipts by looking at the revenue cycle. And so in testing the revenue cycle, we're going to test controls, right? We're going to test the controls over the cash receipts process related to the revenue cycle. So the beginning balance, beginning and ending balances are going to be tested by looking at tested controls over the revenue cycle as it pertains to cash receipts, and also performing tested transactions. Remember, you can perform dual purpose tests, and then obviously test the detailed balances. And we'll talk about those in more detail. So for and then for disbursements, same thing. You're going to look at tested controls related to cash disbursements as a result of the expenditure and acquisition cycle, and test the transactions, the types of transactions that are going to flow, that are going to impact cash related to that cycle, and then account balances. Now you can perform substantive tests and analytical procedures, but I don't know how much information that really gives you with cash, right? Because cash is very fluid, right? So I don't know how much, so you could look at it and say, you know, what was last year's balance as compared to the current year balance, the balance for the current year. And that might give you insight. If you see that the company has a significantly larger balance in the current period as opposed to last period, of course you're going to ask why. Because there are not too many things that affect cash. Either you're generating more cash or dispersing less cash. Maybe you had an influx if the company issued stock, right, towards the end of the year, then you would expect to see that they have a higher cash balance on hand. Right? So again, it's not too many analytical procedures that you're going to perform that's really going to give you a lot of insight into cash. So a lot of your information about cash is going to be largely generated by controls over the various cycles that involve where cash is involved, as well as tests of the account balances. It's important, obviously, I just talked about the controls and why they're important. So when we're looking at the revenue cycle, again, we're testing the controls over receipts, cash receipts. And in the disbursement cycle, we're looking at controls over cash disbursements. So what you're really interested in is the impact of those controls, like how effective are those controls? Because as we talked about, that's going to affect the nature, the timing, and the extent of work that you do with cash. In auditing cash, and then you're going to also look at how the controls related to the bank reconciliation process. And again, the key here is the bank reconciliation process is not an audit process. It's a control activity. Right? So the auditor is going to look to ensure that the company is performing bank reconciliations, and how, not only that they're performing it, but how they follow up on reconciling items. So some of the considerations is, as I pointed out, cash is highly liquid. And so it's coming in. So it is an asset, unless the company has a lockbox arrangement. It's an asset that's going to come in to the company's premises, right? Someone will handle it. Someone can handle checks, and most companies are not going to actually receive cash payments. So we're talking about checks, obviously, when we're talking about cash. When we talk about misappropriation of assets, cash is probably one of the biggest assets where that is a concern. Some strong internal control activities would be, obviously, to have dual custody. So not one person opens the mail. So you'll see a lot of companies, if they do have a lot of checks coming in, assuming that they have it's an easy fit, it's an easy control to implement, is to just have two people be responsible for opening the mail and documenting the cash receipts that come in, and sign off on that. Right? So that way there's accountability. And for cash to be stolen, the two people would have to collude to do that. Right? Even stronger is to have a lockbox arrangement, and you see that with, I'm sure all of you have credit cards or have had credit cards in the past, right? And you pay your credit card bill. Well, now we do everything online, but it's sent to, you know, the receipt is usually a P.O. box, right? So there's usually, or you could send it directly to a bank. So there's a lockbox arrangement. And the other thing you want to see is that you bond your employees who handle cash. So you're basically getting insurance. So those are some key controls. Some of the information processing control activities and physical controls. So things like, you know, remember these are your different types of control activities. So in terms of information processing, you will expect to see a voucher package, and I talked about that. That's what I meant with the three-way match, where you have a purchase requisition. In this case, there are four documents. The difference between a purchase requisition and a purchase order is a purchase requisition comes from the person or department that's requisitioning the goods or services, and the purchase order is prepared and sent to, based on that requisition, is prepared and sent to the vendor to order the goods. And then, so you're looking to see that there's those documents, the purchase rec, purchase order, receiving report, and the vendor invoices. That's what we mean by a voucher packet, is matched to the cash disbursement prior to, right? So that if you're the signer, that if you are responsible for signing checks, that when you get the check, before you sign that check, that you make sure that those documents match. So that's the supporting documents to support the cash disbursement before making that disbursement. That deposits are reconciled to the amounts credited to the accounts receivable subledger, right? Because where else are you generating? And you want to make sure that your accounts are being updated properly, that a bank reconciliation is performed on a monthly basis, performed and followed through. Physical controls would be deposit cash and checks daily and intact. You shouldn't have those things laying around. The company should have a policy where at a minimum it's deposited on a daily basis. I talked about lockbox arrangements. You can have electronic data interchange, dual custody over cash. Unused checks should be secured. This becomes, you know, in this day and age where most transactions are occurring online. You know, I could keep a box of checks for like a year because I pay most of my, you know, I make most of my payments online, right? And most people do that in this day and age. So this is not as big an issue, but you want to make sure, one of the things that we always check is that the unused checks are secure, and you can account for the numerical sequence of those checks. Because people have been known to go in and pull a check out of the middle and forge the check. Check imprinting machines should be safeguarded as well. Check signing machines should be safeguarded because that's a signature. So you want to see that there are proper physical controls over that. Obviously, segregation of duties, separate custody, authorization, recording and execution of the transactions. And what we mean by performance reviews is that someone is reviewing that these procedures are in place, and then as well as reconciliations, including bank reconciliations as well as you know, reconciling other accounts such as accounts receivable or accounts payable, reconciling disbursements and deposits through those different accounts. If you look in your text, Exhibit 6.3 talks about tests of controls for cash receipts. When you want to make sure that cash receipts are deposited intact daily. So an auditor might test that control by observing the process. So when checks come, so if companies, if the policy is that checks mail is opened at the beginning of the day, an auditor wants to observe that that's being done, observe that 2 employees are involved in, and they would surprise them, right? You don't want to announce to the client, oh, I'm going to observe your process today. You want to just show up, right? Why do you think that is? Why does it matter? John?
If they know that you're going to be there, they're going to make sure they do it.
Right, they're in their best behavior, right? If they know that you're going to do it, if you announce to them that, oh, I'm going to come in today and look at you, then of course they're going to be there, they're going to do what they want to do, right? They're going to do everything by the book. When I was an auditor, one of the things I hated was auditing banks, cash counts. And we just would show up at the bank and, a branch and said, oh, we're here to count cash. And we had to surprise them. Right? We couldn't, the only very senior level, because you can't just show up at, Bank of America and just say, I'm going to count the cash. Somebody in the organization, senior, has to know that the auditors are going to come in, right? So, you just show up and count cash, because then you're catching people off guard, right? And the same as an auditor, even if you did this once, you want to even surprise them again and do it, because once you've done it, then like, okay, the cash counters, they've observed it. If you're doing something wrong, you can go back to doing it. But if the auditors are there and then they just show up again, you catch them off guard. You want to create some element of surprise or uncertainty. You don't want the client to know every single thing you're doing every time, right? Because in that way they know your audit approach. You want to also make sure that a listing of all checks is being prepared and then compared to the total deposit ticket for the total checks. Again, this is reconciling, right? Making sure, and it's documentation. The client should be documenting cash receipts or cash disbursements, tracing the deposit ticket to the bank, and then for a sample, they want to also look at controls that ensure that deposits are reconciled to the accounts receivable subledger. So they could take a sample of the daily postings and reconcile that or tie that back to the accounts receivable subledger, and that would be completeness. So occurrence deals with that, right? So if you have 2 employees opening the mail and it's you're looking to see that it's a valid cash receipt, that it actually occurred. Looking at comparing the checks to the deposit, make sure that it's accurate. Looking at the deposit ticket, to ensure that it's recorded in the proper period would be an example of cutoff. Exhibit 6.4 looks at the same thing, but from the perspective of disbursements. You want to make sure the checks are not printed until voucher packets are prepared. Remember, the voucher packets include all of the documents necessary to support that disbursement. And that's occurrence, right? If you know that, for example, if you take a sample of cash disbursements, and you want to know that those are valid cash disbursements, you're going to tie those back to receiving reports, right? Because the receiving report tells you that you actually received the goods. Why is it not enough to just tie it to the purchase order? What does the purchase order tell us? What's a purchase order? It's in the name, kind of tells you. Purchase order. Okay, so your brain is dead. John?
It's basically when you order, it doesn't necessarily mean that you received.
Right, exactly. You ordered the goods. It doesn't tell you. So a purchase order by itself is not enough to support a cash disbursement. A receiving report does, right? Because a receiving report tells you that you actually received the goods. Now, does the receiving report tell you if that purchase is valid? Why or why not? Jimmy, you want to say something. Debate. Just throw it out there. It's not a test.
My manager always asks me, where's the PO? How to present the PO, then check receipt and then check invoice.
Exactly.
All three at the same time.
Exactly.
Every day, like 500 times.
Right, until it made you sick, right?
Yeah, that was the grunt work.
Yes. You get by that, though. It doesn't last forever, right? And that's it right there. The purchase, the fact that you receive goods tells you, well, yeah, we accepted these goods, but it doesn't tell you it's a valid purchase, right? Because what tells you it's a valid purchase is the purchase order, that it was an authorized purchase. That's what makes it a valid purchase, that it was an authorized purchase. So that's the importance of having those 3 items. Okay, an employee compares the amount on the printed checks with the voucher packages. That's accuracy. Only authorized signers are permitted to sign checks, and that's important. So usually as a part of understanding the client and reviewing the control, controls, an auditor is going to get a list of who's authorized to sign what, all authorized check signers. Again, that deals with occurrence, that it's a valid disbursement to signed by an authorized person. Checks are pre-numbered, a keyword pre-numbered and accounted for. You scan a sequence of checks. You'll see this when you do your ACL project. You can actually do this in ACL. And that deals with the completeness assertion, and bank reconciliations are prepared on a timely basis, right? Because here what you're concerned with is that checks, the transactions, cash transactions are recorded in the proper period, so your concern here, the assertion that the auditor is testing is cut off. Any questions so far? Okay. So let's take a look at a problem. Problem 43 in chapter, I think it's chapter 6. Yes, chapter 6 is the audit of cash. So problem 43, and that is on page 255. This is in chapter 6, employee fraud and audit of cash. Yes. So as a hint, since this is dealing with the disbursement cycle, you might want to jump ahead to the chapter on disbursements and find the answers. It's there for you, you just have to find it. the acquisition and expenditure cycles. You guys have a text? You're on. You have a text. You have it on ebook. Oh, okay. So for example, the completeness assertion, right? So again, if you look at the transaction related assertions, that should help you. Okay, about 5 more minutes and then we'll go through this together. Yes.
One quick question about the
Sure.
project. For like part 2, do we have to do all of them on the same computer? So are they all going to connect to one part? Like, do they fall through to each other? Build up to them, or can like?
Some of them you might have to, let's see. No, I think you might, I have to look at, but I think you could do it separately. You might be able to do it
Like all of
separately.
them are like, do you know, like we do all of them separately? Or like?
You mean each of the questions?
Yeah.
Yeah, I can't say for sure because I'd have to look at the questions again. But you should be able to allocate it. So there might be certain parts, maybe question 1 and 2 you'd have to do, and then somebody could do. But I can't remember the exact questions. Yeah, but you don't have to do. I don't think you have to do them all on the same computer.
Okay.
But you're gonna have to talk. You might have to talk to each other to
Of course.
answer them. Yeah.
All right. Thank you so much.
Okay, let's take a look at this together. All right, so what you want to look at is think about the assertions related to transactions, right? Because we're talking about cash transactions that are going to be related to either the cash receipts, and in this case, we're talking about disbursements. So you want to look at what are the objectives or the assertions that management's making about disbursements or transactions related to purchases and disbursements. And so that's why I suggested to you to look at the chapter on acquisition and expenditure cycle. So what's the first assertion that we know? Transaction assertion. And how does that relate to cash? What are you looking for? Occurrence, right? And so what is occurrence? When we say the management is making assertions that something occurred, what's the assertion about?
Existence, going back from documents to sources to source documents.
Right, so if you started with cash disbursements, right? Because remember, occurrence, you want to make sure that it's a valid transaction, right? So if you're starting, so that means you want to start with, I want to see what's recorded in the disbursement journal let's make this related to cash. So I want to see what's recorded in the disbursements journal, and I want to make sure that what's recorded in that disbursement journal is valid. So how do we determine that it's a valid disbursement? Trace, right. So select a sample of cash disbursements and trace it to backwards where? And what's the source document that we're tracing to? Voucher package. What's in the voucher package? PO, invoice, and receiving report. Right? So that's what I want you to think, right? If I'm talking about occurrence, I want to make sure it's a valid transaction. So I'm going to start with a sample, selecting my sample from the cash disbursements journal and tracing that to supporting documentation, which for disbursement would be the voucher package. And the voucher package includes the purchase order, receiving report, and vendor invoice. And in some cases, the purchase rec, depending on the company's procedures. Right? And that tells me that it's a valid transaction. All right, what's another assertion that we look at? Completeness, and they gave you the example of the completeness, but let's talk about that. So what's our concern with completeness?
That it's actually
The occurrence is that it's in, right, but occurrence tells us that,
concerned about account balance and completeness.
right, so completeness, right,
Frontward,
right, so we're going from the source documents back to the disbursements journal, right? Because our concern with completeness is that we want to make sure that all disbursements that should be recorded have been recorded, right? Because we're concerned about understatement, right? With disbursements, that's an understatement. If you didn't record it, that's an understatement, right? So we're more concerned with understatement. So they would, again, you would select from the source documents and tie that back to the cash disbursements journal to make sure that all cash disbursements were recorded. That should have been recorded, have been recorded. So what's another assertion that we're concerned with?
accuracy of the statement.
Right, and so what would be a test of control? We would look for what?
Would you make comparisons from their source documents to whatever's recorded on there to the journal?
So you'd want to look at quantity, you'd want to look at amounts, right? You'd want to recalculate, right? Price list, tracing it back, okay? Jimmy, you had a question? Right, exactly. It's another very good point Jimmy made. With occurrence, you also want to see that there's proper authorization, right? That not only that we received the goods, but also that the person who signed it is an authorized signer. That's what makes it valid. Right? That also that's the validity of it, because then you know that that person who has the authority to sign off on those disbursements are accountable. Right. Okay. So we talked about accuracy. What's some other?
Cutoff and classification.
Cutoff and classification. So let's talk about cutoff. What will you do for cutoff? What are we concerned with cutoff? What are we testing?
Recorded that transactions are recorded within the correct period.
Right, in the correct period. So how would you test that? In cash disbursements.
You would look at, when you take into consideration the voucher package, because it would indicate sort of that it was performed, like that transaction.
Right, so you could look at, for example, right, when did you receive the goods? When were you billed, right? Because the receipt of the goods tells you that's when you created a liability. When you received and accepted those goods, you generated a liability, right? So that's the receivable, the liability side of it. What about the disbursement side of it? What's your concern? When would you record that disbursement? When you pay it, right? So what would you look for? I hope that's when you record that disbursement. That is accrual accounting, right? So what would you look at to determine when you paid it? It's not a trick question. What would you look at as an auditor, what would you look at to determine when it was paid and whether or not? The date on the check. Right? The date on the invoice doesn't tell you the day that you paid it. That just tells you the date that you were billed. Right? But when you pay it, the disbursement, you're going to look at the check dates to see when that check was issued. Right? So when it was issued. Right? Because you don't want it when it clears the bank, because there's a disbursement when you issue the check. Right? Okay. So you also said classification. How will we test classification? What are we concerned with classification? Right, that is recorded in the right account.
Make sure your balance sheet cash account is in place, your payables, your receivables.
Right, so you would look to make sure, for example, if you're talking about general disbursements, generally a company will have several cash accounts, and at a minimum they're going to have an operating cash account, which is the account that they use to pay, general operating expenses. They'll also have an impressed payroll account, where only payroll expenditures flow through that account, and then of course they have petty cash. Right? Those are all cash accounts on their books and records. So you want to make sure that those accounts they're classified properly. Right, that only operating expenditures are going through the operating account, and only payroll expenditures are going through the payroll account. So that's what you perform procedures to look at that. So let's just quickly summarize this problem. Right, so with we talked about occurrence, and we talked about the fact that you want to make sure that the transactions are valid, the disbursements. So the auditor would observe, remember, who has custody, because you're concerned about segregation of duties. So an auditor would observe that process. Who's signing the check? Look for evidence that there is a proper segregation of duties. Look for things like there's dual custody of checks when they come in the door. Also, under occurrence, you want to make sure that, again, that they're valid, it's documented. It represents payments for goods and services received. So you would select a sample of the cash disbursements recorded during the period from the cash disbursements journal, compare to canceled checks, examine there's a proper, it was signed by the appropriate person, and that there's matching records. Compare the recorded amount and the check amount, compare the recorded payee name and name on the check. Scan the recorded cash disbursements for any large or unusual amounts, and perform the same steps as you would do from 2A through 2D. Also with occurrence is looking at cash disbursements being signed by those people who are authorized and in accordance with the company's policy. Right? So again, some people have, and most companies, there are very few people who have blanket authorization to sign for disbursements, right? So they're usually at some tiered level, that depending on your level, you could have, if you're a department head, you might only be able to sign off on disbursements up to, let's say, $25,000. Anything over $25,000, you have to go you know, the CFO, let's say, for example. So you want to look at what that chart is like and making sure that people are authorizing purchases in accordance with the company's policy. So you could examine supporting documents for proper authorization, tracing the authorized signature to the list of authorized approvers, trace vendor name to the approved vendor list. We'll talk more about some of these more detailed controls, such as the vendor list, when we talk about the acquisition cycle. We talked about accuracy, that the dollar amount's correct, and the calculations are correct. So recalculate the amounts on the supporting vendor's invoice and compare that to the check amount. And this is an important control that clients should have in place, right? Because they shouldn't just, you get a document or you get a billing invoice from the customer, I'm sorry, from the vendor, you shouldn't just accept that that is right. And you don't know what kind of controls the vendor has, so you can't rely on their internal controls. You have to rely on your own internal controls. So you have to ensure that, you know, you want to see evidence that you're checking the vendor's invoice, making sure that that invoice, it foots, that the extensions are correct, so that you're not being overbilled. If there are cash discounts involved, you want to make sure, see evidence that the company is you know, calculating the cash discounts, and what if the company's policies that you pay so that you take advantage of cash discounts, the auditor wants to see evidence that that's being adhered to. Talked about classification, that accounts, cash disbursements are classified in the correct accounts. So again, obtain a chart of accounts, because as I said, the company could have several cash accounts, and then make sure that the disbursements are properly classified in the correct accounts. We already talked about the completeness assertion here. You're concerned about understatement. You want to make sure that all cash disbursements that should be recorded have been recorded. So foot the selected summaries of cash disbursements, trace those totals to the general ledger debit and credit entries, and then foot the general ledger cash account. And then the cutoff assertion, again, is making sure that cash disbursements are recorded in the correct period. So again, observe cash disbursement procedures, talk to management. If there are checks that are being held for an unusually long amount of time, you want to find out why that's being done. Compare the date on the check to the recorded disbursement. Compare dates to payee, bank's clearance, date for any apparent lengthy delays, right? Because if a check was issued, I don't know, December 1st, and then you're seeing that that check didn't clear until 3 months later, that's kind of unusual. So you want to follow up on that. Okay. Any questions about assertions and tying those assertions back to disbursements? And this, we would do this was the same process that the auditor would go through, looking at cash receipts as well, looking at controls over cash receipts. And as you'll see, when we talk about disbursements, you'll see some of these controls are going to be things that the auditor would test as a result of testing controls over the acquisition cycle. All right? Good? Okay. So that talked about test of controls. Then we also perform substantive tests, substantive tests of detailed balances or substantive analytical procedures. As I said before, you have analytical procedures have limited applicability to cash, right? Because it's not going to tell you a whole lot, right? You can do some things like look at, as I said, look at last year's balance, the current year balance. You could also look at cash receipts, for example, as in its relationship to sales or in its relationship to accounts receivable. So there's some things that you can do, but usually what you're going to see is auditors are going to compare it with prior year balances and then compare it with budgeted amounts, and just to see some indication if companies budgeted a certain amount, where they believe that they were going to be, what their cash position was going to be, then you look for anything that would suggest any unusual amounts. If it's significantly different, obviously that raises a red flag or something that you obviously would want to talk to the client about in more detail. So it really has limited ability to tell you much about what's going on in the cash account. In terms of the test of detailed balances, Usually what the audit procedures are going to involve bank reconciliations. And so what the auditor would do is get a copy of the client's bank reconciliation, and auditors will send out cash confirmations. And cash confirmations, unlike accounts receivable confirmations, are not required. Right? The standards suggest them, but you don't have to do them. Right? And amazing, most audit firms will confirm cash. It's a standard audit procedure, but it's not one that's covered by the standard. Now there is a move, and I think there's a proposed standard, and I don't remember if it's been approved yet, but there is a proposed standard to look at, to require that confirmations of cash be performed. There's also what we call, there's this company that does electronic confirmation. So it's almost like a confirmation clearinghouse. And so companies will subscribe to this, and as well as banks, and that's how they'll confirm. So it goes through this confirmation clearinghouse, yes?
What you just mentioned is actually required now. Most banks don't even care.
Right, most banks, so most banks, right, the banks will require it, but what I meant by required in terms of the standards, right? Right, so the banks will, so most banks are kind of forcing their clients to use this confirmation process, this electronic confirmation process that kind of goes through this confirmation clearinghouse. Because you can imagine banks, especially if you're a large multinational bank, right, you're getting hundreds of thousands of confirmation requests from your customers. And so it's a major issue for them. And so most banks are like saying, look, if you want us to confirm, you're going to have to go through this clearinghouse. I had a case, but I don't think we're going to be able to get to it, that actually goes through this electronic confirmation process. It has you walk through it. So an auditor is going to request a standard bank confirmation, and they're also going to request a cutoff bank statement from the bank. And that's basically how they audit the cash balance. Other evidence that they're using to test cash we went through is the cash receipts journal, cash disbursements journal, bank reconciliations. They're going to look at canceled checks, year-end bank statements, and as I said, the bank cutoff statement. And so some common audit procedures that an auditor is going to perform with respect to cash is they're going to look at get the bank reconciliation. They're going to compare the bank balance to what's recorded on the confirmation and what's recorded in the company's books and records. So the confirmation is just like a receivable confirmation, except that you're confirming directly with the bank. And you also want to get a cutoff statement. And with the cutoff statement, you're looking to see the timing, right? Because the cutoff statement is usually after year-end. Because what the cutoff statement will tell you is those reconciling items that were on the year-end bank reconciliation. In a cutoff statement, those things should have cleared. So you shouldn't see those items still on the cutoff statement as a reconciling item. You want to look at, so in terms of your procedure to reconcile, you start with the balance per the bank, which is from your confirm, the cutoff statement, add the deposits in transit, and that, because those are deposits that the company made that haven't yet cleared the bank, you should be able to trace those to cash receipts journal and vouch those to the cutoff bank statement, right? Because you're looking at the bank reconciliation as of 12/31. So you're going to trace those cash receipts to the cash receipts journal, and then you're going to see that they cleared the bank in the cutoff statement. Subtract any outstanding checks, right? So those are checks that the company's issued, but they haven't cleared the bank yet. And so the auditor is going to vouch those cash disbursements to the cash disbursements journal, and they're going to also trace it to ensure that those checks have now cleared the cutoff statement, which the cutoff statement is subsequent to 12/31. Any kind of debit or credit memo, so bank fees, for example, that the bank charges the company, and then reconcile that to the balance per book, right, to make sure you have identified all of the reconciling items, and then basically foot the reconciliation. You want to make sure it's correct and accurate, and then trace that amount back to the trial balance to ensure that the trial balance includes the correct amount. So that's your audit of cash. As I said, confirmations are now done electronically. And as pointed out, most banks, especially the major banks, they won't even confirm. They're not even going to look at a paper confirmation. They won't even respond to it. And they tell their customers that we only do electronic confirmations. And so, but in any event, the auditor has to control it, whether it's electronic or whether it's a paper, right? So what are some of the, what's some of the pros and cons of an electronic confirmation? Let's start with the pros. What's good about electronic confirmations, do you think?
They can be traced back. So that when they send an e-confirm, they can be, but it's there.
Right. So I think what Ricardo's trying to say is that when there are electronic confirmations, you know it's going to the bank, right? You know it's going to a debt because in setting up these electronic confirmations, the bank will have designated, right, that there is, that this is where the confirmations are going, that they have a person or department that handles those confirmations. So you know that it's going to a legitimate person in that banking organization. Right. Right, it's more timely, right, because it's not less paperwork. John, same thing, right? What are some of the negatives, do you think? Any negatives? Electronic confirmations? You don't think there are any negatives?
There is.
But you just don't know what it is. Well, so what you're dealing with, right, is now we're in, again, it's technology. And so you as an auditor, like, because there are different, clearing houses, right? What you don't know as an auditor is that black box, right? Because you don't get to audit that black box because that's not your client. So what you don't know what kind of controls exist or what kind of security they have over that process. So what you would do is get what we call a audit report, like it's SOP 78, I think, but I can't remember the exact number. But you get basically a report from the clearinghouse about their controls. Well, their auditors will issue, because they expect this, right? Their auditors will issue a report about the controls, for that, let's say the clearinghouse. And an auditor would request that report. And they would review that report to see that there are no significant control deficiencies. So that's one of the drawbacks, is that you don't have control over that. You can't go in and audit it. So you're relying on the fact that the controls that exist and the security that exists in terms of, because you only know what's coming out of that process, right? And so you're relying that there are controls in place to control that the output from that process. So standard banks. You can also, and getting with these standard bank confirmations, you're going to also request information about potential contingent liabilities, right? So if the company has an outstanding line of credit, if they have any loan agreements or contingencies, contingent liabilities or secure transactions. Remember we talked about the fact that, you talked about the secured credit facility in one of the cases, right? So that information you'd also request on the bank confirmation. I already talked about this. Many banks, as was pointed out, require this, and you complete it electronically. The professional standards have been expanded to allow this to be an acceptable form of audit evidence. And obviously, because you're dealing with it being done electronically, there's less human intervention that increases, hopefully, the quality of the information that you're getting out of the process. Some of the things that just fraud, moving to just quickly talk a bit about fraud with respect to cash, is check kiting, where there's a deliberate floating of funds between two accounts. So basically, you're lapping, moving funds between two accounts, and so you are trying to, company might be trying to, if the operating a cash account, if they have debt covenants tied to that, they might try to do something to make those accounts look better than they really are. This, because of technology, right, and bank scrutiny, you know, you don't see this as much in recent years. But a way that an auditor looks at this or tries to identify whether or not that any check kiting is going on is to do a schedule of interbank transfers. So look at movement of money or funds between the company's bank accounts. A proof of cash would be something that auditors would do if they couldn't rely on internal controls. So basically they have to, you know, prove the cash disbursements and cash receipts by looking at the sources of that information. You're looking at basically 2 bank reconciliations, looking at all of the reconciling transactions that occurred during the period, and reconciling those items to the cash receipts and cash disbursements journal. So it's a much more detailed analysis of the flow of cash through cash receipts and cash disbursements journal. Other things that an auditor wants to do with respect, because again, remember, cash is highly liquid, so it is one of those accounts where, you know, you have you consider the fraud risk, misappropriation of assets. Count the petty cash twice in one day, so this kind of goes along with the line. So yes, you show up once to count it, maybe count it another time, right? So again, on a surprise basis. Look at the endorsements on canceled checks carefully, right? Because, you know, most companies, if you're sending it to a valid vendor, you know, most times they're going to stamp it, right? They're going to stamp it with the company's name and logo, you know, and it's going to go directly into that company's checking account. So you want to look carefully to see, make sure that it's not necessarily a person who is signing off on it, or if just looking at it to see if it looks strange. Remember, general journal entries are important. So you always want to look at to see if there are any unusual journal entries in your cash account, right? Because if you think about it, for your operating account, your cash is coming from receipts and receipts into the cash accounts and disbursements out of the cash account are pretty much generally going to be receipts from the cash receipts journal and disbursements from the cash disbursements journal. So you shouldn't see a lot of topside adjustments. And what I mean by topside adjustment be adjustments that are not, that are debits or credits to the cash account is not generated by either of those 2 journals, right? So you want to look closely at the journal entries. This is a little different retreat, I mean, because most times you don't have checks. Way back in the day when I was an auditor, all of the checks, the company got them back. Nobody gets checks back. So, I mean, we don't even get checks. You guys probably weren't even born, so you don't even remember that the bank would send you your bank statement and you have all your canceled checks in there. That doesn't happen anymore, right? You want to look at what kind, remember when we did the skepticism case early in the semester and the auditor looked at the currency, they looked at how new the checks were, they looked at the serial number, that kind of stuff. You know, that's just being skeptical. You can look at the deposit lag time, examine documents for alteration. Remember, we're kind of in this day and age where, you know, technology, word processing programs allow you to reproduce very, very believable documents. In fact, this has absolutely nothing to do with auditing. As I was getting ready for work this morning, I was listening to the Today Show, and they had this segment on where apparently this young man sent his girlfriend a letter. And she'd been accepted to some university. And this letter said, "We're sorry, we regret to inform you that your grades are not what we expected. So basically, we're rescinding our offer." Now imagine when you go to college, you think you're on your way to college, and they're like, "No, we don't want you," right? So this is what he said, and it was on the school's letterhead. It was, and so it was believable. And then further down, he says, he had some line, "Unless you agree to go to the prom with so and so," and it turns out it was a prank. But initially, when she got the letter, I mean, it came in an envelope and in school. So I'm sure that the college or university wasn't in cahoots with the boyfriend, right? So he was able to obviously copy it so that it was very believable. I didn't see the document, but because I was getting dressed, I was just listening. But they said it was really genuine. It looked really real. You saw that segment? So that's what you could do.
It was actually online.
It was online a few days ago. So, I mean, this is what you could do with, just word processing. So, and I'm sure it was a good university, so it's not like she was a dummy. She didn't realize that it was, a fake letter. But anyway.